It strikes me how many people I know, maybe even you listening, have, dipped a toe into the stock market with a trading account.
Yeah.
It's become almost commonplace, right? But I often wonder if that's the whole picture of finance. Is investment banking just jargon for like Wall Street professionals?
hmm
Or does it actually weave into our daily lives in ways we maybe don't realize?
That's a really insightful question, actually.
Yeah.
And the connection might be, well, more direct than you think.
Oh, yeah.
Yeah. Those securities firms where lots of people, maybe like you, open their stock accounts.
Yeah.
In China, um, these are basically the entities that carry out what's understood as investment banking in many other parts of the world.
Really? Securities firms are investment banks.
In that context, yes. And it's not totally unique to China. You see something similar in Japan, in Germany,
Hmm?
where these places are often just called securities companies.
Oh.
So in this deep dive, our goal is really to unpack what investment banking truly is, particularly within that Chinese context, and figure out its relationship with the commercial banks we're maybe more familiar with.
Right. Because it's true. When I think of these securities firms, the first thing that pops into my head is them earning a commission every time I make a trade.
hmm
Why is that perception so common, especially in China?
That perception is pretty understandable. It stems largely from the way things developed historically, the business model in China's investment banking sector.
Mm.
A really big chunk of their revenue comes from retail brokerage, which
Okay.
is basically opening accounts and charging commissions on trades for individual investors like us.
Right.
What's interesting is that, globally, retail brokerage is usually a pretty small slice of the pie for big investment banks,
Yeah.
typically less than 10% of their total revenue.
Wow. Less than 10% globally.
Yeah.
That's surprisingly small. So what does it look like in China then? Is it much higher?
Oh, substantially higher. In China, the reliance on retail brokerage is around 50% of the total revenue for these securities firms.
50%.
Yeah. And if you look back just a few years, it was even higher, sometimes 70%, maybe even 80%.
Whoa.
And this heavy dependence, well, it's created a super competitive market. Loads of firms are all chasing the same retail clients.
Ah, okay.
That intense competition. That's exactly why you might get those frequent calls from brokers, offering fee waivers and stuff to get you to open an account with them.
That totally explains it. Okay, so if investment banking is more than just helping me trade stocks, what other crucial stuff does it involve?
Right. It actually covers a much broader range of activities. A really core function is securities underwriting.
Underwriting.
Yeah, that's basically helping companies issue and sell new stocks or bonds to raise money from investors.
Okay, got it.
Then there's mergers and acquisitions, M&A for short. That's where investment banks advise companies wanting to merge with or buy other businesses.
Right, like figuring out the price and the deal.
It's exactly valuations, deal structure, financing, the whole thing. And then there are related, maybe more specialized areas like asset securitization, leverage buyouts, private equity investment, even using complex math models for quantitative investing.
Okay, so the scope is definitely way wider than I first thought.
Mm.
How does the money side work? Like the revenue breakdown globally versus in China?
Globally, the picture is quite different.
Mm-hmm.
Often proprietary trading. It's basically the bank trading with its own money, hoping to profit directly.
Okay.
That can be the biggest chunk, sometimes over 70% of total revenue.
70%.
Yeah. Then underwriting and M&A usually make up another 20% to 30%,
Yeah.
which leaves retail brokerage, as we said, is a pretty small piece globally.
Huh.
And it's interesting, famous foreign investment banks often specialize. Like Morgan Stanley is known for underwriting,
Mm.
Goldman Sachs for M&A, and Merrill Lynch, historically anyway, was big in retail brokerage.
But that's fascinating. So what about the big players in China? Are they also moving beyond just retail?
Definitely. Leading Chinese firms, like CICC, CITIC Securities, China Merchant Securities, they've absolutely made progress. They're getting more active in underwriting and M&A.
Okay.
Those parts of their business are growing. But if you look at the overall scale and maybe sophistication, they still generally lag behind the big international players.
But it sounds like there's still a lot of potential for growth there.
Absolutely. Huge potential.
Yeah.
Given China's economic growth, all the cross-border activity,
Right.
local investment banks have a massive opportunity.
Right.
If they can leverage their local knowledge and build up that expertise in underwriting, M&A, all that stuff, they're really well positioned for the future.
Yeah.
Maybe something we can dig into another time.
Okay, so we've got that securities firms in China are basically investment banks, doing more than just our stock trades. But that name, investment bank, it makes you ask about their relationship with, regular commercial banks. Have they always been separate things?
Yeah, that's a crucial question. It gets right to how the whole modern financial system evolved. Before the 1930s, the line was really blurry.
Blurry how?
Well, the term investment bank as a separate category didn't really exist. They're generally all just called banks.
Huh.
Think about a powerhouse back then like J.P. Morgan. They did everything. Took deposits, made loans, but also underwrote securities like the bonds for the Erie Canal or the railroad,
Wow, all under one roof.
all under one roof.
Yeah.
They had branches taking deposits from regular people. And at the same time, they were managing these huge investment deals. Rockefeller, Citibank, they were involved in both sides too.
So it was a much more like integrated system back then.
Exactly. The early 20th century was a big growth period for these mixed model banks. The economy was booming. Regulation was, let's say, looser.
Okay.
Banks could use the money people deposit in, savings accounts to fund securities, underwriting, and trading. There wasn't a clear wall between your safe deposit and the risky stock market.
Ooh, that sounds potentially quite risky. What changed?
You're absolutely right. It was risky. Depositors wanted safety, stability. The stock market, well, it involves risk. The turning point was the huge crash in 1929.
The Great Depression.
Exactly. Stock prices just tanked like 90% down. It caused widespread bank failures. About a third of all banks collapsed. People lost their life savings.
Devastating.
Totally. And it starkly highlighted the danger of mixing safe deposit taking with risky securities trading in the same institution.
So what did they do? What was the fix?
The government stepped in with a landmark law,
Huh?
the Glass-Steagall Act in 1933.
Glass-Steagall. Okay.
This act basically forced a separation. It mandated a clear split between commercial banking and securities operations. Banks had to choose.
Choose what?
Either focus on taking deposits and making loans, what we now call commercial banking, or specialize in securities underwriting and M&A, which became investment banking.
Ah, okay. So that's where the split came from. And how did that play out for, say, J.P. Morgan?
Well, the Morgan Group is the classic example. It literally split in two. Morgan Stanley was formed to handle the investment banking side,
Right.
and J.P. Morgan continued as the commercial bank. Citibank chose to focus on commercial banking too, and sold off its securities arm.
Okay.
So after Glass-Steagall, investment bank became the specific term for those firms specializing in securities and investments, separate from the traditional deposit and loan commercial banks.
That history really clears up why we have these two separate types today. Now, I heard this kind of funny analogy, describing commercial banks as married men and investment banks as happy bachelors.
Yes, I've heard that one. It's quite descriptive, actually.
What's it getting at?
It really captures the fundamental difference in how they're regulated and the kind of risks they take, especially after that separation. Think about commercial banks, the married men.
Okay.
They handle our deposits, right? They're crucial for the economy's stability through lending. So they face very strict government regulation.
To protect our money.
Exactly. Safeguarding savings is key. So you have things like deposit insurance, strict rules stopping them from using deposits for risky stock trading, tight controls on their capital, how much they can borrow.
Okay. Lots of rules, very stable, responsible.
Yeah.
Like a married man with responsibilities.
Precisely. Heavy responsibilities for public funds. So they tend to be more risk-averse, less impulsive, focused on stability, predictability.
Got it. So what about the investment banks? The happy bachelors?
Right. The securities business is seen differently by regulators. The basic idea is that investors in the market know there are risks, and they accept them.
Market carries risks. Investors must exercise caution, that phrase.
That's the one.
Yeah.
Because investors bear their own risk, investment banks face comparatively less restrictive regulation than commercial banks.
More freedom.
More freedom. It allows them more flexibility to be innovative, and engage more creative brainstorming with complex financial products and deals.
So the happy bachelor part is about having fewer obligations, more freedom to take risks, maybe chase higher rewards.
Exactly. They can take bigger risks, explore new strategies, be more agile, more opportunistic. They don't have that same heavy obligation to protect public savings directly.
Okay.
So while they might both have bank in the name sometimes, their basic business models, the rules they follow, their whole attitude towards risk, completely different.
Which is why investment banks don't usually offer savings accounts or take deposits from just anyone.
Precisely. Fundamentally different roles in the financial system.
That analogy actually makes the difference really clear. Okay, let's dig a bit deeper into some of those specific investment banking activities. You mentioned asset securitization. What exactly is that?
Okay, think of it like making pies.
Pies.
Yeah. The filling for the pie is made up of a pool of financial assets. These could be things like mortgage loans, lots of home loans bundled together, or maybe credit card receivables, the money people owe on their credit cards.
Okay, so grouping together similar debts or loans, that's the filling. Then what?
Right. Once you have that pool, that filling, it gets repackaged. And then it's sold to investors as new financial securities, new slices of pie, if you will.
And the investors get paid back from the original loan.
Exactly. The value and the cash flow of these new securities come directly from the payments being made on those underlying assets, the mortgage payments, the credit card payments.
Got it. And you also mentioned resecuritization. What's that? Making pies out of other pies.
Huh. That's actually a great way to think about it. Yes, resecuritization products are like compound pies.
Compound pies. Okay.
Instead of using the original loans as the filling, They use simpler securitized products like those mortgage-backed securities, MBS we just talked about, as the main ingredients.
So you take existing MBS, bundle them up, and make a new security.
Precisely. You add another layer. You pool existing securitized products and repackage them into new, often more complex securities. And you can even do it again, making pies out of compound pies.
Wow. Okay, can you give a specific example of how that works?
Sure. Let's say you have a bunch of different mortgage-backed securities. Each one is already a pool of individual mortgages.
Right.
In a resecuritization, an investment bank might take, say, certain slices or types of these existing MBS, pull those together, and issue a brand new security based on that pool.
And the payments for this new security come from the payments on the underlying MBS.
Exactly. The cash flows just pass through the layers.
So why do this? Why make these compound pies? What's the point of resecuritization?
Well, one big reason is it can increase financial leverage.
Leverage, meaning more borrowing or exposure?
Sort of. The process often involves pooling together the riskier bits, maybe the lower quality slices, from those initial securitized products.
Okay.
Then they repackage this pool, slice it up again into different tranches, different risk levels.
Yeah.
They can sell the safer, higher quality slices to investors who want less risk.
And the riskier slices.
They might keep those or sell them to investors looking for higher potential returns who are willing to take on more risk. The whole process lets the issuer move assets off their balance sheet, freeing up capital.
Ah, freeing up capital.
Yeah, and it lets them raise more funds by selling these new securities. So effectively, yeah, increasing leverage.
Okay, that makes sense. Now, shifting slightly, converting loans into bonds. How does investment banking make that happen?
Right, that's another core function. Investment banks act as the intermediaries. They take loans, package them into bonds, and then sell those bonds to investors in the bond market.
Can you walk me through an example? You mentioned Ant Group's Huabai earlier. How would that work?
Sure, the Huabai example is pretty illustrative. Huabai is Ant Group's consumer credit service, right?
Starting a virtual credit card.
Kinda. So first, Alibaba Microloan, the part of Ant Group that actually makes the loans via Huabai, gathers up a portfolio of these Huabai receivables, basically what users owe. Then they sell this pool of receivables to a separate company called a special purpose vehicle, an SPV. This SPV is typically set up and managed by an investment bank. In that case, it was Devon Securities.
Devon Securities. Okay, so they buy the loans.
The SPV buys the receivables. Then Devon Securities, managing the SPV, takes them, repackages them, maybe adds some features to make them more attractive.
Like credit enhancements.
Exactly. And they slice them into tranches, different levels of risk and return. Essentially, they turn this pool of receivables into bonds.
Okay.
These bonds then have to be checked out, audited by law firms, accounting firms, and approved by the stock exchanges before they can be sold.
Right, due diligence.
Finally, Devon Securities issues the bonds, sells them on the bond market to investors.
So Alibaba Microloan gets cash up front by selling the receivables, and Devon Securities facilitates the whole process of turning them into bonds and selling them.
Precisely. Alibaba Microloan is the issuer looking for funding. Devon Securities is the facilitator using securitization to make it happen.
And commercial banks can do something similar.
Yeah, the logic is pretty similar for a commercial bank wanting to, say, free up capital tied up in loans on its books. The bank would be the issuer.
Okay.
They typically work with a trust company, which acts as the intermediary managing the SPV. The trust company repackages the loans and issues bonds, usually through the interbank market, after getting approvals.
So for both, securitization is basically a way to raise money, with an investment bank or a trust company acting as the middleman.
Exactly. It's a financing tool, and you need those intermediaries to structure it and sell it.
That's really clear. Okay, this leads nicely into the idea of direct versus indirect financing. Can you break down the difference?
Sure. Think about how money moves from savers to borrowers. In indirect financing, like getting a loan from a commercial bank,
Right.
the bank is the intermediary. It checks your credit, takes the risk if you don't pay back, and if you're a depositor at that bank, putting money in a savings account.
Yes.
You generally have no direct link to who borrows your money, and you probably don't know exactly how it's being used. It just goes into the bank's general pool.
Okay, so the bank's in the middle, managing it all, taking the risk.
Exactly. Now, direct financing, like this securitization we just talked about, is different.
How so?
Here, the issuers, the company needing capital, like the microloan company or the bank selling its loans, they sell securities, like bonds, directly to investors in the market.
Okay.
Investment banks or trust companies help make it happen. They facilitate it. But the key difference is the investors buying those bonds have a much clearer idea of what their money is backing.
Like they know it's backing a pool of Huabai loans in that example.
Right. There's a more direct connection between the issuer raising funds and the investor providing them.
Got it. That makes the distinction much clearer. Okay, one last area. Securitizing cash loans by online lending platforms. Do these platforms just do it themselves?
Generally, no. Online lending platforms usually don't handle the whole securitization process on their own. They typically lack the specific qualifications the Z needed to do it directly.
So they need help.
Yeah, they have to work with qualified intermediaries, trust companies, asset managers, licensed brokerages to actually carry it out.
And are there specific requirements, like entry rules for doing this?
Yes, there are several key requirements, or zonrutiujian. First, the underlying assets, the cash loans themselves, have to be legitimate and transferable. Clear ownership, Zaiquan, no legal issues.
Makes sense.
Second, the issuer, the online platform, needs to meet certain standards itself, like credit ratings, financial health.
Okay.
Third, as we said, you need qualified intermediaries, involved law firms, accountants, brokerages, to make sure it's all done properly and follows the rules.
Right.
And finally, the whole plan needs regulatory approval from the stock exchange or the interbank market before they can actually issue the securities.
Okay, so it's a regulated process. Now, what happens if one of these online cash loan companies, after securitizing its loans, goes bankrupt? Do the borrowers just stop paying?
No, not at all. Remember that SPV, the special purpose vehicle?
Yeah, the separate company that holds the loans.
Exactly. The ownership of those loans was legally transferred to the SPV. It's a separate legal entity. So even if the original lending company goes bust, the SPV still owns the loans and has the right to collect payments.
So the borrowers still have to pay back the loan just to the SPV now?
That's right. Their obligation doesn't disappear just because the original lender failed.
That's really important to understand. Okay, last question on this. Why don't these online cash loan platforms just plug into the main bank credit scoring systems? Wouldn't that help them assess risk better?
It seems logical, but there are a few key hurdles. First, data privacy and compliance. Accessing something like the central bank's credit system involves really strict data protection rules.
Okay.
Some online platforms might struggle to meet those standards, maybe because of how they collect or handle data. Second, there's often a mismatch in risk appetite.
Oh, so?
Online cash loans often go to people with lower credit scores. Folks traditional banks might see as too risky. Banks are generally more conservative and might hesitate to integrate fully with platforms serving that higher risk segment.
Right, different target markets.
Exactly. And lastly, potential conflicts of interest. Some cash loan platforms charge higher interest rates, partly because of that higher perceived risk. If they were fully plugged into the bank system, borrowers might become more aware of cheaper options from banks, which could, potentially hurt the platform's business model or increase defaults.
Okay, so it's complicated. There are real barriers there.
Definitely. It's not as simple as just connecting the pipes.
Oh, this has been incredibly enlightening. So just to kind of wrap up the key takeaways, we've established that investment banking, especially thinking about securities firms in China, is way broader than just handling our stock trades. It's fundamentally different from commercial banking, historically, legally, and in terms of risk.
Absolutely.
And this tool, securitization, is a really key part of what they do, transforming all sorts of assets into things investors can buy, which has big impacts across the whole financial system.
Precisely. It's complex, but it's a vital mechanism for moving capital and managing risk in the modern economy.
So thinking about all this evolving financial world, these increasingly complex tools like securitization, what do you see as the big opportunities or maybe the challenges ahead? For us as individuals and for the economy as a whole, that's definitely something to chew on.
We genuinely love to hear your thoughts on this. Jump into the comments section and let us know what resonated. Which type of wealth are you focusing on?
Yeah, let us know.
And hey, if you found this discussion useful, maybe learned something new, definitely hit that subscribe button. We do these deep dives regularly, exploring valuable ideas.
We appreciate you tuning in.
Yeah, thanks for joining us.